Right now, millions of people are opening bills and experiencing the same moment of shock. A rent renewal notice showing a $300 monthly increase. A property tax statement jumping 40% in a single year. A health insurance premium that's tripled from $128 to over $900 per month. These aren't isolated incidents happening to unlucky individuals. This is the new economic reality facing families across the developed world as we move into 2026. And the data suggests this is just the beginning of a structural affordability crisis that will reshape how entire generations live. The mathematics are straightforward and unforgiving. Since 2020, the baseline costs of survival have increased at rates that wages simply cannot match. Motor vehicle insurance has risen 56% in 5 years. Electricity costs are up 40% across most regions. Rent has increased an average of 30%, while food prices have climbed between 25% and 38%, depending on category. But here's what makes 2026 different from previous years of inflation. These increases aren't slowing down, they're accelerating in specific sectors that people cannot avoid. Before we break down exactly what's coming and why it matters to you, make sure you hit that subscribe button and turn on notifications. The information in this video could change how you prepare financially for the next 12 months. Let's start with housing, because this is where the crisis becomes most visible and most devastating. Property taxes in multiple municipalities have increased between 30% and 70% in single assessment cycles. A homeowner paying $6,000 annually in property taxes can suddenly face a bill for $10,000 or $13,000, with no corresponding increase in income or property improvements. That's an extra $300 to $600 every single month that must come from somewhere. For renters, the situation is arguably worse because they face increases without even the theoretical benefit of building equity. Rent increases of $200 to $400 monthly have become so common that they're no longer shocking, they're just expected. But why is this happening? Why are costs rising so dramatically across so many categories simultaneously? The answer lies in a convergence of factors that are compounding each other. Aging infrastructure across developed nations requires expensive upgrades. In the United States alone, utility companies are passing billions in grid modernization costs directly to consumers through rate increases. Climate change is driving up insurance premiums as extreme weather events become more frequent and severe. Insurance companies are either raising rates dramatically or pulling out of entire markets, forcing remaining providers to charge even more for coverage. Meanwhile, the technology sector's explosive growth is creating unexpected cost pressures. Artificial intelligence data centers consume massive amounts of electricity, straining power grids and driving up costs for everyone on the same system. In regions where major tech companies have built server farms, residential electricity bills have jumped 15 to 20% in single years as utilities struggle to meet commercial demand while maintaining aging residential infrastructure. Healthcare represents perhaps the most dramatic example of costs spiraling beyond control. Families that were paying $125 monthly for health insurance in early 2025 are receiving renewal notices for $400, $700, or even $1,100 headed into 2026. And these aren't premium comprehensive plans. These are basic coverage options with deductibles of $5,000 to $8,000 that must be met before insurance provides any real benefit. The result is a system where people are spending $12,000 to $15,000 annually just for the right to pay thousands more out of pocket before receiving care. Transportation costs are following similar trajectories. Gasoline prices in certain regions are projected to reach $7 to $8 per gallon by mid-2026 due to a combination of refinery capacity constraints, regional taxation policies, and distribution challenges. Vehicle maintenance costs have risen 48% since 2020 as parts become more expensive and labor rates increase. Auto insurance has jumped 56% in the same period, making car ownership increasingly untenable for lower and middle-income families. Food inflation continues relentlessly despite periodic predictions that prices will stabilize. Beef prices are projected to increase another 5% in 2026 on top of a 15% rise in 2025. This isn't driven by temporary supply disruptions, but structural changes including the smallest cattle herd sizes in decades, climate impacts on feed production, and increased costs throughout the processing and distribution chain. Families reporting grocery bills of $500 to $600 every 2 weeks for basic items are becoming the norm rather than the exception.
The psychological impact of these changes extends far beyond the financial stress. People describe grocery shopping, once a routine task, as an exercise in anxiety and mental mathematics. Constantly calculating costs, putting items back, second-guessing purchases. The simple act of feeding a family has transformed from a basic responsibility into a source of ongoing stress and difficult choices. Rent increases that once would have triggered outrage now elicit resignation because they become so predictable. The normalization of financial struggle represents a profound shift in how people experience daily life. What makes all of this particularly challenging is the mismatch between economic indicators and lived experience. GDP growth remains positive in many countries. Stock markets reach new highs. Unemployment rates stay relatively low. Yet individual families are drowning under costs that rise faster than wages can keep pace. This disconnect reveals an important truth. The metrics used to measure economic health often fail to capture whether ordinary people can afford basic necessities. A strong economy, as measured by GDP, doesn't pay grocery bills or cover rent increases or make healthcare accessible. And here's what you need to understand about why 2026 will test every household's financial resilience. The affordability crisis entering 2026 isn't temporary inflation that will resolve when interest rates adjust or supply chains normalize. This represents structural changes to how costs relate to income in developed economies. Understanding why these changes are happening and what they signal about the next several years is essential for anyone trying to maintain financial stability. First, recognize that many of these cost increases are intentional features of economic policy, not unfortunate accidents. When central banks raise interest rates to combat inflation, they're deliberately making borrowing more expensive. It forces businesses to reduce hiring and slow wage growth. It makes mortgages more costly and credit card debt more burdensome. The stated goal is to cool economic demand by reducing people's spending power. The unstated reality is that this cooling mechanism primarily impacts those living paycheck to paycheck, while barely affecting wealthy households or large corporations that have cash reserves and access to different forms of capital. The housing crisis demonstrates this dynamic clearly. High interest rates make mortgages unaffordable for potential buyers, which keeps those people renting. But landlords face higher costs for property taxes, insurance, and maintenance, which they pass directly to renters through increased monthly rates. Meanwhile, home prices don't fall significantly because supply remains constrained, and existing homeowners with low fixed-rate mortgages have no incentive to sell. The result is a system where neither renting nor buying provides financial stability for average earners.
Healthcare costs reveal another dimension of the problem. Insurance premiums are rising dramatically, partly because subsidies that helped lower-income families afford coverage have been reduced or eliminated in some regions. Without government support keeping premiums artificially lower, the true cost of healthcare in privatized systems becomes visible. Families suddenly facing $900 to $1,100 monthly premiums aren't experiencing price gouging. They're experiencing what health coverage actually costs in markets without robust public options or heavy subsidization. The shock comes from years of hidden costs being transferred to direct consumer payments. Employment trends add another layer of concern. Projections suggest significant layoffs in early 2026 across multiple sectors as companies adjust to higher operating costs and slower consumer spending. Unemployment rates that remained relatively stable through 2025 may rise to levels not seen since pandemic disruptions. For individuals already stretched thin by rising costs, job loss becomes catastrophic rather than merely difficult because there's no financial buffer to absorb the impact. So what can individuals do in this environment? The honest answer is that personal financial optimization can only partially offset structural economic pressures. No amount of budgeting eliminates a $300 monthly rent increase when income hasn't risen proportionally. No grocery shopping strategy prevents food inflation when beef prices rise 20% cumulatively over 2 years. However, understanding the landscape does enable better decision-making about what's controllable. Focus on reducing housing costs if possible, even if it means difficult choices about location or living arrangements. Housing typically represents 30 to 40% of household budgets, so this is where changes have the largest impact. Build emergency funds aggressively during any periods of income stability, because the combination of high costs and potential layoffs makes having 3 to 6 months of expenses saved more critical than ever. Prioritize health over convenience, because healthcare costs are reaching levels where a single emergency could trigger financial crisis without insurance, yet insurance itself has become barely affordable. Most importantly, recognize that the exhaustion so many people describe isn't personal failure. It's the rational response to a system where costs outpace wages, where basic security requires constant financial vigilance, and where one unexpected expense can unravel months of careful planning. The economy isn't broken from the perspective of those it's designed to serve, which is capital holders and large corporations, but it's increasingly dysfunctional for people who work regular jobs and need to afford housing, food, healthcare, and transportation. These are verified trends already impacting households globally as we enter 2026. The question isn't whether costs will continue rising. The question is how individuals and families navigate an economic environment where wages can't keep pace with necessities. If you found this analysis valuable and want more honest breakdowns of economic trends that affect your daily life, smash that like button right now and subscribe with notifications on. Share this video with anyone who needs to understand what's really happening with costs in 2026. What are you seeing in your region? Are your costs following these patterns or experiencing different pressures? Drop your experience in the comments below. Real data from real people helps everyone understand the full picture of what we're facing. Thanks for watching, and I'll see you in the next video